Good morning. It's Mike Lynch with Cross Country Mortgage, and it's time for your Monday morning mortgage update for the week of November the 13th. Hope you all had a great weekend. I give you these updates, deliver them to you every Monday morning to give you some insight about what's happening in the market, give you some tools and tips and tactics so that when you go out and talk to your buyers and sellers, you have knowledge, you have some insight about what's happening, and you can have those intelligent conversations with them when they ask you about the market. I always try to talk about what happened last week and what's going to happen in the week to come. So let's talk about last week. What happened? We saw a 53 basis point sell-off in the bond market. Mortgage rates are determined by the trading of mortgage-backed securities in the bond market. This graph, I show this to you on a regular basis, represents the trading of mortgage-backed securities. When we see this graph go down and we see the red bars, or we call them candlesticks, represents 1 day of trading. You can see if I move my cursor here, this is a live feed, the dates change. That means money's flowing out of the bond market, rates are going up. When we see the green, that means money's flowing into the bond market and rates are getting better. So we know the last couple weeks, we've seen a nice rally, rates have gotten better. And the last week, we saw rates get a little worse, 53 basis point sell-off, money flowing out of the bond market. The media reports this as rates shot up. Put this in perspective. We're nowhere near the lows we were, or the highs, in rates at the end of October. So this is just a little bit of an adjustment. Two things caused this. Number one, the debt that the government sold last week, we talked about that, competed against 30-year mortgage-backed securities. And nobody bought mortgage-backed securities last week. They bought government debt because they feel more confident that the government-backed bonds and notes are going to give them more stability than notes backed by mortgages. Plain and simple. The other thing is consumer sentiment. A big report came out on Friday, comes out every single month, that gives us an insight on how confident consumers are in our economy, with their money, what are things looking like now and in the future. And there was an element to this report that talked about what they felt about inflation. And most consumers felt inflation was going to be much higher moving forward, much, much higher. And that's not good for rates. We know inflation is the death of rates. And the bond market reacted to that because consumers feel that way. Not that it necessarily is true, but that's how the consumers see the economy moving forward. So what are we looking at this week? Really two things: inflation and retail sales. So we get inflationary reports every single month, and we get two of the big ones: CPI, Consumer Price Index, tomorrow, and PPI, the Producers Price Index, on Wednesday. The Consumer Price Index measures the inflation on consumers, how much they're paying for stuff, and the PPI, the Producers Price Index, measures inflation, how much are businesses paying for stuff to make stuff. And so we expect these numbers to be flat or increase at a very low rate, much lower than they've been going up in the past. And so that is positive. It's a good shift. That could be positive for rates. But if we see these go up higher, if we see the numbers actually be above expectations, it'll be negative for rates because inflation is the death of mortgage rates. That's why the Fed's been raising the Fed fund rate since March of last year. The second thing is retail sales. So we're heading into the big retail sales months. We know that. And this report will be for October. And it's going to give us an insight about what we may be able to expect for November and December when everybody buys stuff. And if we look at the savings rates in the US, the savings rates are a little low, flat, but a little low. But if we break it down and look at the top wage earners, their saving rates have really been unaffected by the economy. It's the lower half of wage earners. Their savings rates have been decimated, very, very low. And so will they spend money this holiday season? This October report is going to give us an insight on what we should expect in the holiday season. So pay a lot of attention to that. And obviously, if people are buying less stuff, then that's bad for the economy. And that is good for mortgage rates, unfortunately, because that means inflation's coming down. Good for mortgage rates, fortunately, bad for the economy, unfortunately. So the last thing is a tip of the week. One of the big properties out there that's ignored a lot are properties that need work, properties that have deferred maintenance. They're unloanable. And a lot of times buyers just look at these properties and have a sense of overwhelm. How am I going to get these fixed up? And sellers typically aren't willing to do the work. If it's a bank repo, they're not going to do the work. So the solution is a rehabilitation loan. And these have been around for a long time. The great thing about these loans is a buyer can buy a house and take the money out as part of his mortgage to do the work. Now, these have a negative connotation on them. A lot of people had bad experiences with these rehab loans because of three things. The lender they work with didn't know how to structure them. They didn't have the team to make sure that they knew how to submit these correctly to underwriting, and they didn't have the investors that specialized in these. We have been doing real rehabilitation loans for 20 years. We have put together a ton of these loans. We know how to structure them. We know how to get them done in a very efficient manner. So we're not nickel and diming buyers and sellers and you're having a bad experience. And we have the investors that back these loans. So don't ignore the houses that need work. It just may give you 1, 2, or 3 deals through the holiday, through the slow time of the year. And we can show that buyer how they can buy this house, the worst house on the block, and get a great deal and come out with a home that's in much better shape. So give me a call if you have any questions on that. Have a great day, and we'll talk to you soon.